Dividend stocks remain a cornerstone of a strong, income-generating investment portfolio. Whether you're a retiree seeking passive income or a long-term investor looking for compounding gains, picking the right dividend stock can make a significant difference. However, not all dividend stocks are created equal. Some offer stable, growing payouts backed by strong fundamentals, while others lure investors with high yields but come with significant risks. As we head into 2025, one dividend stock stands out as an excellent buy for long-term investors, while another appears risky and is best avoided. Let's explore both in detail. Top dividend stock to buy in 2025. Johnson & Johnson, J&J. Why Johnson & Johnson is a strong buy. Johnson & Johnson, NYSE, J&J, has long been a favorite among dividend investors, and for good reason. The company boasts a rock-solid balance sheet, a diversified business model, and a track record of consistent dividend growth. With healthcare demand remaining strong regardless of economic conditions, Johnson & Johnson is poised to continue rewarding shareholders in 2025 and beyond. 1. A dividend king with reliable growth. Johnson & Johnson is a dividend king, meaning it has increased its dividend for over 50 consecutive years. As of 2024, the company has raised its dividend for 62 consecutive years, a testament to its financial strength and commitment to shareholders. With a current dividend yield of around 3%, Johnson & Johnson provides investors with a solid combination of income and long-term growth potential. 2. Strong business segments and revenue growth. Johnson & Johnson operates in 3 primary business segments. Pharmaceuticals. The company produces leading drugs in oncology, immunology, and neuroscience, which continue to drive revenue growth. Medical devices. J&J's surgical and orthopedic devices are in constant demand, ensuring stable revenue streams. Consumer health. The recent spin-off of its consumer health segment, Kenvue, allows Johnson & Johnson to focus on its high-margin pharmaceuticals and medical device businesses. Despite economic uncertainty, the healthcare sector remains recession-resistant, making Johnson & Johnson a safe bet for income-focused investors. 3. Strong financials and low debt. Johnson & Johnson maintains a AAA credit rating, one of the highest in the industry, indicating strong financial health. The company consistently generates high free cash flow, which allows it to invest in research and development while maintaining steady dividend payments. Additionally, Johnson & Johnson has a low debt-to-equity ratio, making it well-positioned to navigate economic downturns. In an era where rising interest rates have burdened debt-heavy companies, Johnson & Johnson stands out as a financially secure dividend stock. 4. Consistent earnings and a safe payout ratio. J&J's payout ratio hovers around 50% to 60%, meaning it pays out only a fraction of its earnings as dividends. This ensures that the company retains enough capital for growth initiatives while continuing to reward shareholders. Outlook for 2025 and beyond. As the global population ages, demand for healthcare products will continue to rise. J&J's strong pharmaceutical pipeline and steady medical device sales position it well for long-term growth. With its reliable dividend, strong balance sheet, and industry-leading reputation, Johnson & Johnson remains a top dividend stock to buy in 2025. Dividend stock to avoid in 2025. AT&T. Why AT&T is a risky bet for dividend investors. While AT&T, NYSE, has historically been a high-yield dividend stock, it has faced significant financial and operational challenges in recent years. Despite its 5% plus dividend yield, the stock carries considerable risks that make it one to avoid in 2025. 1. Dividend cut history and sustainability issues. AT&T's reputation as a dividend stock took a major hit when it cut its dividend in 2022 following the spin-off of Warner Media. Once considered a dividend aristocrat, the company's inconsistent dividend policy makes it an unreliable choice for income investors. Even though AT&T still offers an attractive yield, its payout is not as safe as that of other blue-chip dividend stocks like Johnson & Johnson. 2. High debt levels and interest rate risks. One of the biggest red flags for AT&T is its massive debt load. As of 2024, The company has over $130 billion in long-term debt, making it one of the most indebted companies in the U.S. With higher interest rates, AT&T faces increasing borrowing costs, which can pressure its ability to maintain its dividend. Unlike Johnson & Johnson, AT&T has a much weaker balance sheet and struggles to generate consistent free cash flow. 3. Stagnant growth and competitive pressure. The telecom industry is highly competitive, with companies like Verizon, T-Mobile, and emerging 5G players putting pressure on AT&T's market share. While the company has made strides in expanding its 5G network, its growth remains relatively stagnant compared to peers. AT&T's revenues have remained flat to slightly declining, which is concerning for a company struggling with high debt. 4. Poor capital allocation and past management decisions. AT&T's history of poor capital allocation decisions is another reason to stay away. The company's expensive acquisitions of DirecTV and Warner Media turned out to be disastrous, leading to billions in write-offs and divestitures. These missteps highlight management's inconsistent strategy and raise concerns about the company's ability to drive sustainable shareholder value. 5. Dividend payout ratio concerns. AT&T's current dividend payout ratio exceeds 70%, which is high compared to more stable dividend-paying companies. A high payout ratio, combined with debt concerns and low growth, means that AT&T's dividend could be at risk in the future. Outlook for 2025 and beyond. While AT&T may still attract investors looking for high yield, its long-term risks outweigh the benefits. The company's high debt, weak growth prospects, and history of poor decision-making make it a risky dividend stock for 2025. Investors looking for stable dividend income should consider higher quality, lower-risk alternatives like Johnson & Johnson. Final thoughts. When it comes to dividend investing, quality matters more than yield alone. A high dividend yield is tempting, but if the company's financials are weak or the dividend is unsustainable, the risks outweigh the rewards. Johnson & Johnson J&J remains one of the safest, most reliable dividend stocks to own in 2025. With its strong balance sheet, recession-resistant business, and decades of dividend growth, it is a perfect stock for long-term income investors. AT&T, on the other hand, presents significant risks due to its high debt, inconsistent dividend history, and weak growth. Despite its high yield, the stock lacks long-term stability, making it a poor choice for dividend-focused investors. By focusing on quality, financial health, and dividend sustainability, investors can build a portfolio that generates reliable income while minimizing risks. For 2025, Johnson & Johnson stands out as a clear buy, while AT&T is a stock to avoid.